I should maybe use reverse psychology. So this is going to be really boring, and then you'll show up. Okay, so let me switch to the slides. Okay, so let me just do it in presentation mode.
Mark, do you think we could ask a couple questions about the project?
Yeah, of course.
Okay, great. Is it fair, by your email, you said that we can essentially assume that the equities part of the pension belongs to the S&P, right?
Yep.
Is it fair to assume that it's not entirely in equities, however?
I would say it doesn't really matter for your assignment. So the idea is that, or the premise of the assignment is that you're in a large institutional investor, and I think even specifically say pension fund. And so if that's the case, like the typically like, so from that, what you can take is it's going to be a well-diversified, perhaps even global portfolio. And it'll have like majority will be index positions, but there will also obviously be all kinds of like overweights and underweights relative to the index, and unique positions, and like you know, what some people call like high conviction equities, where we'll take a larger stake in a company so that we can have some dialogue and influence in management. There may even be private equity. Yeah, I mean, of course, the equities will be not just purely some index, but I would say that 90% of the risk would be would be proxied by an index. And even like I mentioned that the portfolio is probably going to be global. So you may think, oh, well, why are we using like S&P, which is US centric, or exclusively US? And so one thing is that the US is 50% of the market cap of the equity market. And the other thing is that the other equity markets are highly correlated to the US market. So all that being said, what I think you guys may be overthinking it, because all I'm saying is I've got, like, you arrive there on the scene, you don't have details into exactly what you hold, but you do know that it's essentially like equity risk. And you know that the tool for you know, the tail hedging equity risk would be the options in S&P 500. And the reason why I would pick options S&P 500 is because that's the most liquid, deepest market for options, and it's the most vanilla. So there are like S&P futures. There's like, you know, it's just the kind of the default decision, and it's not going to be like perfect, but it'll get you like, you know, 90% up the way there, so to speak, in the sense that it will you could use S&P to hedge off typically about like at least 90% of your risk from your equities.
Okay, thank you. And just one more quick thing.
Yep.
Do you want us to only simulate Q1 of 2020, or do you also want us to show that our strategy kind of holds for before that, just so we don't like blow the whole 1% each and every year up until 2020? You know?
Yeah, absolutely. This has nothing to do with Q1. Q1 is only a good test case, because what you'll probably find is that's the time that you're, there'll only be a few episodes where your tail hedging program will pay off. And it's those brief periods of payoff that have to make up for all the losses over the history. So your exercise is really to strike that balance between managing the costs during like the market being either like neutral or positive, and versus the payoff that you get during a market crash.
Okay, so if our strategy does blow the 1% every year up until a crash, the crash should actually make up for all those lost 1% for all those years.
Yeah, absolutely. Or if it doesn't, you have to think of some kind of other justification where that would, because otherwise, if it doesn't, it means that you're willing to pay away money for something, which may be perfectly valid. Oh, sorry, there's a bunch of people waiting. So it may be perfectly valid to say, yes, I'm willing to pay away money to cut off the left tails. but you have to justify what it is that you're receiving. So for example, are you receiving correlation benefits? Are you receiving a lower drawdown in a crisis, which means that your liabilities will not be as impacted? So all those considerations.
Okay, thanks very much.
Yeah, so I'm just thinking about what you said about blowing your budget every single year. Yeah, so obviously that's one strategy, and it could be a perfectly valid strategy, but I'm looking for something like that. That's a pretty naive strategy. So I'm looking for something a little bit more nuanced. So for example, let's say the market has just crashed. So it will be the case in let's say the end of Q1 of 2020, or it will be kind of like March of 2009. And so the market is very low. So in other words, it's cheap on a PE basis. And also volatility will be very high. And so what that means is that it's a double whammy in the sense that your options will be expensive because volatility is high. And the kind of the upside opportunity for your options is lower than it would normally be. So I would argue that that would be not a good time to be spending your budget. Whereas if you looked at something like how the S&P is relative to some valuation metric, like you saw Cliff Hassness talking about the cyclical PE ratio, and he was advocating for that as the measure for the value for equity. So if you did something like, I'm going to fully deploy my budget when the Shiller PE, or also called this KP or cyclically aggressive PE, I would ramp up my budget when that is high, and I would lower my budget when that is low. Just to give you an example of this a little bit more sophisticated strategy.
Okay, sure. Yeah, that makes sense.
Okay. Any other questions?
Hi, Mark. I have a question on hedging return. Is that simply the return of portfolio minus the cost on purchasing options or something else?
Yes, but just the cost of the options divided by the total AUM. So let's say you're managing a $100 billion portfolio, of all kinds of different asset classes, and then if you have a 1% budget, what that means is on every single year you can spend up to $1 billion on risk premiums, option premiums. So and then what you would do is you'd look at the payoff of those options. So let's say they expired worthless, and so that means if your portfolio would return 9%, then it's only going to return 8% because you paid away 1% in premium. On the other hand, though, if those options make 4 times, have a payoff of 4x, which is a common way of people think about option payoffs. They think in terms of, oh, for each dollar I pay out, what's the multiple that I could make in a market crash? So let's say there's a market crash and your options pay off 4x. So that means that you've earned an additional 4% relative to the total value of your fund. So subtract off the 1% you've already paid, and you've got like a net gain of 3%. So in my example, the portfolio return by itself would be 9%, but with your tail hedging program, it would have been 12%. Now, let me say, I did that example just to keep the math simple, but keep in mind that if there was a market crash, your portfolio return is not going to be 9%. It's probably going to be more something like, minus 9%, and all you're doing is having less losses than you otherwise would have. So in a more realistic scenario is that the market crashes, your portfolio is down 9%, your options pay off 4x, so that brings you back up to minus 6%.
Okay, got it. Thanks.
Sorry, one more person. Okay, so we actually have 22 people now, so that's good. Any other questions on the assignment?
Hi, Mark. I have a question about do we need to write some code to backtest our strategy?
Yeah, so this question, remember I told you each of the assignments focus on a different aspect. So you had like a math assignment, which is clearly the last one. There's a more of like a data / programming assignment, which is the first one. This is more of a management type assignment. So that means it's deliberately more open-ended, and there's more opportunity for creativity for you guys, which means that it's up to you really. So there should be some kind of quantitative analysis. If you want to go as far as doing simulations and back testings, then by all means. And definitely if you were presenting this and you know, as a strategy on like if this was a job assignment, then 100% those would be the type of activities you're doing. But given your time constraints, it's really up to you.
Thanks.
Any other questions? Okay, so I'm going to put you guys on mute, and then I'm going to start sharing the slides. I'm going to go through the material. Okay, so this topic is the like I said last lecture yesterday, that this is I think of this as a second part of the previous lecture on, and the overall theme is value add strategies. And in the first lecture, we looked at hedge funds as vehicles to facilitate generating value add. So that's essentially what a hedge fund is. And then we talked about all the different ways you can classify hedge funds, the key ones being the strategy, and then I mentioned some other ways of classifying them. And then I made the case that even though historically hedge funds have had good returns, especially in the early years, over the last 5 years and probably over the next 5 years, that they've not delivered good returns. And in fact, they've most likely delivered negative alpha, which means that their returns are on average or less, returns on average and after fees are less than the risk-free rate, which is entirely unacceptable. Okay, so then let's see, how many slides? Yeah, so I want to give you guys some intuition about the Sharpe ratio, because sometimes people they don't know, oh, is a Sharpe ratio of 0.5 good? Is a Sharpe ratio of 1 good? So what about like a 2? So just to build up some intuition. And so what I'm showing here is the Sharpe ratio is a function of the lifetime of a CTA. So that stands for commodity trading advisor. Probably a more modern name is like a managed futures hedge fund. And this is the Sharpe ratio is a function of the track record, or the inception for the various hedge funds. And what you'll notice is that there's a lot of noise at the beginning, which is an indication that a lot of the returns are a function of luck. And then as the time horizon lengthens, you find that managers have been around for a long time. It's starting to get some differentiation, and so that the skill is showing up more clearly. So it's almost like a signal to noise ratio. So the signal is the skill, and the noise is just luck. And so the longer you go, the more like the noise dissipates, and you're left with a signal of the skill of the manager. And then if you go even longer, what you're going to notice is that the Sharpe ratio looks like it's kind of converging around like a 0.5. And so I would make the case to you that a Sharpe of about 0.5 is like a realistic and good Sharpe ratio. And so the contrast to that is that if you're seeing, like, let's say you're evaluating investments and you're seeing investment programs that are advertising Sharpe ratios north of 1, I would be very skeptical of those Sharpe ratios. So either the track it's either an indication that the track record is too short and it's just noise, or what it could be that those results are back-tested results, and the back-tested results always have hindsight bias and are always higher than out of sample or live results. So in fact, like when I was in the hedge fund group, we had a rule of thumb that anytime there was a back-tested Sharpe ratio, we'd cut it at least a half. So if somebody showed us a Sharpe ratio of 1, we just say, yeah, well, most likely it's realistically a Sharpe of 0.5. And even that might have been a bit too generous. So that gives you some intuition about what a good Sharpe ratio is. Also, to give you some context, like a Sharpe ratio of a single asset class is about like 0.2, 0.3. And like say the S&P 500 might have a Sharpe ratio of about 0.3. And you think, well, that should be a diversified portfolio, so shouldn't it have a little bit better Sharpe ratio? And the answer is no, because most of what you're earning is equity risk premium. So really, like, you've got like some idiosyncratic behavior, but really you're picking up equity risk premium. It's not like you've mixed in other risk premiums like bond risk premium, default risk premium. So it's not as a diversified a portfolio as you would think. And so then what that means is you should be able to assemble together a portfolio out of a bunch of asset classes or risk premia, the more modern way to think about it, to get a Sharpe ratio that's better than 0.2 or 0.3. And so that's how you end up with numbers like 0.4, 0.5. So just to keep that in mind, that's your intuition for what either a diversified portfolio Sharpe ratio should be, or what a hedge fund Sharpe ratio should be. So another rule of thumb would be that, like, if the target is a 5% excess return, then the volatility should be about 10%, and that gives you a Sharpe of about 0.5. Okay, and then the other thing I want to observe is that some investors deliberately target a Sharpe ratio, and other investors target maximizing their wealth. And remember, in one of the lectures, I talked about Ed Thorpe and the Kelly investing criteria, and how the Kelly criteria betting strategy was the optimal strategy to increase your wealth, but it was also very volatile. Similarly, leveraging your portfolio to I recall the example I used was, if you leverage your portfolio 5x, that's the optimal strategy to maximize your wealth. But not every investor's objective function is to maximize their wealth. And so let's look at two contrasting managers. So one manager is Warren Buffett, and he's more of a Kelly type investor, and which means that he's trying to maximize his wealth. And so if you look at the amount of money that Berkshire Hathaway is able to manage, so I'm not saying this is all Warren Buffett's wealth. It's not even, well, actually, I'm not going to say it's not close, but Warren Buffett as well was worth some, reasonable percentage of this number. But the point is that Warren Buffett is able to run about 400 billion of AUM. And so in other words, he's not really capacity constrained. And that's because he's following like a wealth maximizing strategy. He's not focusing on a maximum Sharpe ratio strategy. So Warren Buffett's Sharpe ratio, even though he's one of the most respected investors in the world, his Sharpe ratio is only like 0.76. And that actually may have, this is from a paper that analyzes his returns, but I suspect his Sharpe ratio has diminished a little bit since then. But anyway, it's still pretty high, but it's kind of not, Warren Buffett doesn't have like the best sharp ratio in the world. Like this would be kind of like a very good hedge fund, but it's not kind of, that out of the ordinary for a high quality hedge fund. Now let's turn our attention to Jim Simons, who's the opposite type of investor. He's a maximum Sharpe ratio type investor. And so his Sharpe ratio is about 1.7. And as I said before, he only manages about 5 billion of AUM in the Medallion Fund, but that generates about 2 billion every single year. Yeah, that's just to distinguish like differences in investment philosophies and objectives. And again, it's this theme from the course that there's no one best way to manage money. So here's another example of two very successful investors, but with very different objectives. Okay, so now we're going to turn to the main topic. And what I'll do is I'll go through the slides, and then where we'll drill down into, like, open up the box for hedge funds and see exactly the types of trades that they put on. And then we'll take a break, come back and do the case. And then we'll go through currency hedging and tail hedging. And then take another break, and I'll cover a question from the exam. And I believe the topic is covering the value add. So the exam question is exactly aligned with the material. And yeah, the reason why I find like this part the most exciting is like, hopefully you get the sense that as you go through this, it'll give you all kinds of ideas, like trading ideas for yourself, that you could actually implement some of these programs yourself. And the idea is that like let's say I present you with 10 different trading strategies, and it turns out that for whatever various limitations, you're able to implement like 5 of them. And so you take those 5 strategies, and those strategies are not just a single trading idea, but it's more of like a process. So remember, I gave you the example of merger arb, where you buy the target company shares and sell the acquiring company shares, and you take on the risk of the deal breaking. And that there's always ongoing mergers being announced and being completed. So that I would use that as an example of like a strategy. And so there's actually nothing to stop you from running that strategy as like a retail investor. And so think about it like this: if I present you with like 10 strategy ideas, you find that like 5 of them you can go implement. You could imagine you could actually put together a pretty good value add portfolio of running these strategies. And so these strategies should be uncorrelated, and so it should be like a well-diversified process. So you could almost imagine, like, after completing this lecture, that you could start running your own mini hedge fund. And so yeah, I hope you guys take some of these ideas from what I'm going to present you. So that's the reason why I find this the most fun lecture. Okay, so let's start with more like, before we get right into the strategies, talk a little bit about like more like the business aspect of having a hedge fund. So this is similar with having a running an institutional portfolio. There's a lot of things you need to put in place just to make sure that the investment process is able to do its job. So you need good leadership. So you want to have like good governance processes. You want obviously good risk control. For example, you don't want to have all your P&L coming from one strategy, or you don't want to have all your P&L coming from one single position. So I think you've looked at this in your assignment. I noted AIMCO for you guys, and it was clearly there's a failure of risk management at AIMCO because they just had a position size too big. Yeah, and obviously because this is, you know, when a hedge fund is very much coming up with new ideas, whether it's fundamental ideas or enhancing the quantitative models, but all of them require like you know, some kind of like intellectual curiosity and working with peers and sharing of ideas and all those good things. So it requires like a pretty high functioning work environment to uh, to achieve this. So, you know, the mental model you could have would be, say, Jim Simon's Renaissance firm, and so that's a team of about, like, I think he mentioned, you know, 150 math and science PhDs and programmers and various other specialists, and so it's very much, I'm sure, it's very much like an academic environment. Bridgewater uh, is I don't think that, you know, they're probably like not as quantitatively driven as Renaissance, but they're also very intellectually curious. They look at they less from the perspective of models, but more like how the overall economy works. And so they're always thinking about like things in those very fundamental terms. So there's another example of a firm that's got like a work environment that allows the value add processes to succeed. Yeah, okay, I'm going to skip these costs, but yeah, I want to skip some of this stuff because I want to get on to spending some more of the time on the value add strategies, which is the more interesting part. But yeah, so we should talk about that. You may not be the trader in the hedge fund, let's say, but let's say you're responsible for the overall construction of the portfolio. So that might mean you know, the risk or the capital is allocated to the various trading desks or allocated to the various models. So some of the things that you'd be thinking about in terms of your portfolio construction is, you know, what kind of regime we're in. So we talked about risk on, risk off. We talked about the all weather being like higher low growth, higher low inflation. There's macroeconomic impacts. So, you know, right now we're in an environment where quantitative easing has stamped down on yields across the yield curve. You know, I talked about sizing in the context of AIMCO. Yeah, and then you can think of a hedge fund as having finite resources which they allocate. And so there's risk to allocate, there's also capital to allocate, and then there's also liquidity considerations to take into account as well. So these are all kind of resources that the person responsible for portfolio construction would be responsible for allocating. Yeah, obviously you want to monitor for diversification. Yeah, these last 2 points are quite relevant. So if you're running a hedge fund and you're charging fees and you're supposed to be delivering alpha, you're going to want to monitor that the return stream they're actually delivering doesn't have beta embedded in it, and because you know that the sophisticated investors will be doing that analysis themselves, and so you want to make sure that um, at the point that you have control over it, that you're actually you know, eliminating or hedging out the beta out of your hedge fund programs or your overall hedge fund return stream. And then another thing too is you want to make sure that, like, if you've got like a bunch of trading desks and they're normally uncorrelated, all of a sudden they start becoming correlated. That's a point of concern. So that's another thing that is like a person responsible for portfolio construction would be monitoring. Okay, and then before we get into actual genuine alpha creation processes, let's talk a little bit about ways that hedge funds could cheat, so to speak. So in other words, they could deliver what looks like alpha, but it's really not true alpha. And you as analysts, it's important for you guys to be able to make those distinctions. So you can imagine that a let's say a hedge fund manager has a certain mandate. So sometimes it may not be an absolute return mandate. It might be to outperform the S&P 500 or emerging market stocks or a fixed income index or whatever. Now, what that manager can do is they can start adding extra risk premiums to their portfolio. So, for example, if the mandate is to invest in or track the U.S. stocks, maybe you start putting in emerging market stocks, or maybe you start adding long-short overlays of these like value and small cap, or maybe you have like a totally unrelated alpha generating process, and you just layer that on top of your portfolio. Well, actually, that's not a good example because that's not actually cheating. So let me take that back. I just want to use examples where you're adding like a well-known economically rewarded risk factor to your portfolio that's not in your benchmark, and therefore it looks like you're adding alpha, but all you're really doing is adding an extra well-known risk premium. Okay, another way that you could generate kind of fake alpha is if you simply leverage your portfolio. And so you can do that explicitly by like, let's say you're tracking to S&P benchmark. What you could do is you could run a 130-30 portfolio, which means that you invest 130% in the S&P and borrow 30%, or you could even short 30% of the names in the S&P. So now, actually, I'm trying to think whether that. Yeah, let me make the distinction a little bit there. So let me distinguish between taking your portfolio and just simply leveraging it. So if I take my portfolio and I borrow 30% and then I buy 30% more stocks, that means my beta is 1.3 to the market. And so generally the market tends to go up. And so anytime that the market goes up, I will earn an extra 30% more than my benchmark. And so then I would point to that and say, look, I'm generating alpha because I'm outperforming my benchmark. Now, the other example I gave you was saying if I took my 100% of S&P stocks, and then I picked my 30 favorite ones, 30% of my favorite ones, and 30% of my least favorite ones, and I added an extra 30% to the ones I like, and then funded that by shorting the 30% that I don't like. That actually is a legitimate alpha generating process. So that's why I wanted to just be careful in that example. So one way is you could explicitly leverage your portfolio. The other way is that you could simply pick higher beta names. So that would typically involve something like overweighting to tech stocks, for example. And yeah, sometimes that will work out for you. So for example, if you had overweighted to tech stocks, that would actually work out well for you. Other times, there's investors that are constrained from using leverage. So there is an extra risk premium from actually investing in lower risk stocks and then leveraging them up. And because some investors are not able to use leverage. So there is like there's kind of a low vol or low beta risk premium that can be extracted. So again, like you're going to notice that it can get kind of gray. So on the one hand, if you just said, okay, I'm going to look through all the stocks and I'm not able to leverage, so I'm going to invest in the more high volatility names and underweight the low volatility names. And that way I'm going to add alpha to my portfolio. So in other words, I'm going to run at a higher beta. And so you would look at that process and say, well, I could easily replicate that, and all you're doing is adding implicit leverage. So that is actually not genuine alpha. So you would kind of reject that as something you'd be willing to pay alpha type fees for. On the other hand, if you had overweighted tech stocks as the active decision, and let's say it wasn't like necessarily like a permanent decision, like maybe in this year you've done your analysis and said, you know what, I think I should overweight tech stocks and underweight, say, leisure and entertainment, and that would have worked out tremendously well in this year. And say in other years you did followed a similar strategy of overweighting and underweighting sectors, but it was like maybe it was different sectors in different years. That process actually is genuine alpha. So it's not alpha from security section, but it's alpha from overweighting and underweighting. So it's almost like a market timing type alpha. And if you're successful at it, then that would be genuine alpha. And I don't know if you guys recall from the very first lecture, we developed like an attribution model where we split up the value add into an allocation term and a selection term. So in the example I just gave you, that would be, you should be able to distinguish a high alpha coming from the allocation term as opposed to selection. Yeah, so another way is that the investment universe for your portfolio is wider than the investment universe for your benchmark, and so that would allow you to outperform the benchmark. So a really nice example is if you're given a benchmark of government bonds, so bonds, let's say bonds issued by the government of Canada, well, you could actually in the portfolio you could actually run could be provincial bonds. And provincial bonds, because they're slightly lower credit rating than government bonds, they tend to trade at a spread to government bonds. And that spread, like say for Ontario, is something like, you know, anywhere between 50 basis points and 100 basis points. And that's pretty much, if your benchmark was government bonds and you were investing provincial bonds, that extra 50 or 100 basis points would show up as looking like pure alpha, when in fact it's really more of an issue that the benchmark was inappropriate, because really the benchmark should really have been the provincial bond benchmark. So there's another a good example of kind of false value add. Yeah, and so you know, I spent a lot of time like teaching you guys how to identify false value add in the sense of using like statistical tools to identify if something really is alpha, to be able to identify if somebody's generating what looks like alpha, but they're really just somehow cheating via leverage or different security sections, or sorry, different investment universes. So those are all good for you to be aware of. I also gave you the example of the track record. So don't confuse luck for skill. So somebody shows you a short track record. So all these things are kind of making you skeptical on that if somebody presents you with alpha, that there's a good chance it may not be genuine. But now we're going to turn our case to examples where the alpha will pass all those tests and is actually genuine alpha. Okay, so what I'm going to do is present a framework for looking for sources of alpha. And as I said, like really alpha is capturing market inefficiencies. So then where do you look for market inefficiencies? And so the framework is to 5 different places where you can look for these. So one is dislocations. So which kind of means things for whatever reason aren't really priced at their reasonable fair market value. The other one is looking for areas where there's non-economic market participants. So a classic example of that would be central banks. So central banks don't participate in the financial markets with the intention of, you know, earning excess return. They're interested in for more like you know, economic reasons. You know, essentially to implement policy objectives as opposed to generate profits. And so we as investors can either, you know, front run, so to speak, the Fed's actions, or, you know, take advantage of their activities because they're not financially motivated. The other one is to look for investors or areas where there's artificial constraints, and so you can take advantage of those. So I gave the example of some investors aren't able to use leverage. Another one that we'll get to is some investors are not allowed to invest in non-investment grade bonds. So that means that if a bond gets downgraded, all of a sudden these investors will have to dump that bond, and so that's another source of market inefficiency, that you, as an unconstrained investor, will be able to buy those bonds at a discount, as an example. Then there's various arbitrage opportunities that can arise. So we'll talk a little bit about those. And then there's relative value relationships. And so I make the distinction between like an arbitrage is, I use that in a term that it's certain to pay off, assuming you hold that position to, or that composition of trades to maturity. Whereas relative value relationships is more of a statistical relationship where things look like they're mispriced relative to each other, and you expect that the relationship will come back to the norm, but there's no guarantee. Like there's not like a mechanism that enforces that. So that's what I mean by relative value relationships. So now let's drill down. Let me just keep track of the time. 6:45, so we're good. Let me drill down into each of those 5 categories. So we're going to drill deeper. So what are types of dislocations? So this is like markets or sectors or strategies that have fallen out of favor and are starved for capital. And so a classic example of that would be, a historical example would be after the financial crisis. Nobody wanted anything to do with structured credit. And so structured credit was really starved of capital. And so you were able to purchase structured credit assets at really cheap prices after the financial crisis. And those ended up paying off for years to come. Maybe an example, a more modern example, which I guess we probably have to wait a little bit longer to see how it plays out. But there's, I can't remember which company, but there's a cruise ship company that issued bonds during the pandemic, and because of the uncertainty of their business, they had to issue these bonds at pretty attractive yields. So you may view that as a dislocation. There may be, due to this coronavirus, there may be all kinds of other dislocations that arise as the economy kind of winds back up, and there's all kinds of things have changed, like how business is done, and what could be successful and what will be like permanently changed. So like we're kind of living through a great example. Like right now we're doing this course online, and so you can imagine that education could be fundamentally changed if from coronavirus, where it's been demonstrated that you could offer like online degrees, and so perhaps instead of having the market dominated by physical universities, you may have a continuum. So if you want to get your degree online, that's like perfectly doable. If you want to do a hybrid where some of your stuff is online and some of it's like online versus physical, online versus physical, and some of it, like let's say maybe the market evolves so that it's only the most prestigious universities where you would actually, it's actually worth the money to go and do like spend the 4 years and do a degree there, like probably the Harvards and Oxfords of the world. So anyway, I'm just giving you a heads up that you could look at various industries that are going to be disrupted due to the coronavirus. So there could very well be a lot of investment opportunities coming up as we get out of this. Another source of dislocation is where highly leveraged investors suffer a margin call. And so there's a phrase for that, is the assets move from weaker to stronger hands. And so I think I even gave an example of this is almost like a form of distressed investing, so that you may be deliberately buying the bonds of well, I'm not sure that's, I'm trying to think of a cleaner example. I'm trying to think of the oil. The oil is a good example. I think that actually is probably a pretty good example. So in your assignment, you probably heard about cases where you had investors that in oil futures, and on the second last day of trading on that contract, they would have experienced a margin call that would have wiped them out. So then maybe you had other investors that stepped in and took over those contracts, and then they would have ended up actually making a lot of money. So yeah, I'm trying to think if I can think of like a cleaner example, but I think you get the idea that like if there's investors are like, let's say retail investors are using a lot of leverage, they get a margin call, they're forced to sell, and then the people that buy those that have cash available to buy those will be buying them at a cheaper price, essentially fire sale prices. Yeah, actually, just as a side observation, sometimes if you watch the market, if it's had a bad day, a particularly bad day throughout the day, you can watch how the trading goes in the last half hour of the day, where margin calls are taking place, or getting settled. So yeah, sometimes you can see things getting sold out around market close. Yeah, so here's more of the example of that I was thinking of, the distressed investing. So I gave you the example of some investors are deliberately buying Hertz debt at a very low price, with the idea that that debt will eventually get converted into equity throughout the bankruptcy process. Yeah, and then so this one is actually probably kind of timely as well. So so the current example would be there's various companies that are searching for either like a treatment for coronavirus or COVID, and or else a vaccine. And there's every now and again you'll see some of them like make an announcement that they've got a breakthrough and the stock will pop, or sometimes they'll say, yeah, we've moved on to stage 1 of clinical trials or whatever. So those are catalysts that will rapidly change the value of a stock. So yeah, carrying on with dislocations. Yeah, so my example of education and is more of an example of like falls under more of this kind of category, where disruptive change allows new entrants to make excess profits. So yeah, obviously like the example you guys will be living through of disruptive change is like COVID, and new entrants could be online education companies, or it could be like other companies that get into that business. Like let's say maybe Google gets into the online education business, for example. So yeah, so some kind of well-known examples would be like Netflix displacing Blockbuster, um, online brokers displacing stockbrokers, high-frequency trading displacing market makers, hedge funds displacing bank prop desks. So I don't know if you guys know, but there was like I think it was, what was it, the Volcker rule, that restricted investment banks from doing proprietary trading. So what that meant is a lot of proprietary traders went out and either started their own hedge funds or joined hedge funds. You know, Uber versus taxis, Airbnb versus hotels. So yeah, there's a lot to unpack with those last couple of examples. So like one example for these would be certainly COVID is going to alter the business model for Airbnb. So we'll see how that transpires, because there's a lot of influences, right? Like the extra cost of cleaning, the people traveling less. On the other hand, though, it's probably like a relatively like low contact business. So all kinds of issues. Yeah, another example I like to use is the how the taxi business was disrupted. So I don't know if you guys are aware, but at least in Toronto and New York, probably elsewhere, but taxis operate on like a medallion system. So somehow, I guess the government or city or whatever issued a bunch of medallions, and so there's only like a finite supply, and that medallion is required to operate a taxi. So what that means is you could split out driving the taxi versus owning the medallion, which is what ended up happening. And so these medallions would trade essentially as assets. And so you'd have people that would have like more than one. So they have like a little portfolio of medallions, and they would rent them out, and it would provide like an income for them. So this was essentially their portfolio. So you may be able to rent out like the medallion for like, I don't know, like 7% a year, 10% a year, or something like that. So, and then these medallions would be have significant value. Like, I think maybe like a taxi medallion in New York might have been worth at one point like $1 million. So you can imagine, like, if you owned one of those, and that would generate $70,000 worth of income for you. So it's quite a valuable and interesting and attractive asset to own. But then you can imagine what happened when Uber came along. What do you think happened to the value of those medallions? And so, as a fun exercise, what you could do is you could just like Google on Kijiji, like a taxi, the cost of a taxi medallion in Toronto, and I think they used to be like a few $100,000, and I think they're significantly less, maybe like 50 to 100,000. So there's an example of disruption. Another interesting thing is you can wonder, like, where did that economic value go to the medallions? And so clearly it was lost to the owners, but where did that go? Was it just lost, or was it captured by the market cap of Uber? So the answer is probably like partially yes. Was it captured by lower fares for the users of taxis or Ubers? The answer is, I think, a definite yes for that as well. And the reason why I say, like, I would be actually more convinced of that is because I'm not even sure if Uber is profitable. I don't think they are. So really what it is, up to this point, it's a way to subsidize taxi rides for its customers. So sometimes it's fun to think about where that value is captured. And so, yeah, this is drifting a little bit off topic, but you have to think when there's a disruptive change happening, you have to think, well, who's capturing the value of that disruptive change? So there's not necessarily, it may not necessarily be a good idea to invest in Uber, say after its IPO, after its growth period, if the value is not being captured, like the value of the disruption is not being captured by Uber, rather it's being captured by the customers. And oftentimes you see like a lot of like Silicon Valley type companies that actually is the case. They want to grow so fast that they will exchange revenues for growth. So they'd rather lose money but show growth than make money and grow at a slower pace. And with the concept that they have is that they want to establish a monopoly, and then once you establish a monopoly, then you can start charging like monopoly type prices. So in other words, you can extract additional rents, so to speak, rents in an economic sense if you have a monopoly. So this is why Uber is so keen to become like a de facto monopoly. Okay, so that was a lot on dislocations. So now we're going to look at the second area where you can look for market inefficiencies, aka alpha. And so that's like non-economic market participants. So I gave the example of central banks. So let me give you an example. So if you're aware that the government or the central bank was implementing like a quantitative easing program, what quantitative easing means is that the government, the central bank will go into the market and buy bonds. So what that means is that you could buy the bonds ahead of the central bank and then sell it back to them. And so, you know, if you looked at it, that strategy would mean very profitable. See what else? Yeah, there's also, yeah, this is a great example of non-economic market participants, and it comes from like behavioral finance. So people will overpay for lottery tickets. And so if you can give them payoffs that are kind of like exciting, that they will overpay for it. And you as running like a portfolio of those can make excess returns. So if you're selling deep out of the money options on a bunch of stocks and you just repeat this process, every now and again it's going to pay off, but you're going to be like almost like the lottery operator, or you know, you almost can think of yourself as like kind of running the casino, that you're making a spread on the chance of payoff versus what they're paying. And if you can think more broadly of that, you can think of all kinds of cases where this arises. Okay, yeah, index rebalancing. So this is another one that's kind of like a well-studied arbitrage or source of alpha, but it's maybe too well known for in other words, it's kind of being arbitraged away just because it's so well known and taken advantage of or exploited. So, but it's the idea that various indices will every now and again have to rebalance. So let's say, you know, the S&P 500 is the 500 largest stocks, but let's say every quarter some of the names will drop below the threshold size, and other names will grow big enough to belong in the index. And so what that means is that the S&P 500 will announce the index rebalancing changes. So for the S&P 500, like that it's just a list of names with weights beside them. So it doesn't create any, you know, activity on the index provider's part, but there's so many like billions and tens, if not hundreds of billions of dollars that track the S&P 500 that has a big effect on the market. So as these various like ETFs, for example, that track that index, so those ETFs are going to be forced to sell the names that are out of the index and buy the names that are going into the index. So again, like I use the term front run loosely because front running is illegal, but I just use it in the sense of like not in the legal sense, but just like in buying ahead. So I use in the colloquial way of just buying ahead of somebody else. So it's not necessarily illegal, but you're just essentially you're front running the index, and that you're you know that they're going to have to buy, and so you buy it first, and then you'll be the one that sells it back to them. And so when this kind of idea was popularized, it was relatively easy to make excess returns doing this. But then other people, caught on to this idea, and so then they would, like, let's say you would buy the stocks like one day before the names changed, and so somebody would come along and they would buy the day before, and then somebody else will be even more clever and they'll buy it like 3 days before. So you get the idea that because the arbitrage is so well known, that it tend to smear out, and so now it's not such a big deal, I believe. And also probably the indexes may be a little bit more, they may give themselves a little bit more flexibility in adding and subtracting the names. So I'm not sure if that's true or not, but I can imagine that that's what they would do. So that arbitrage is probably, value add opportunity is probably pretty diminished. So if you want to exploit those kind of strategies, you maybe have to be a little bit more clever in the sense of maybe trying to anticipate well ahead of time a name that will get added versus names that will get removed. Okay, another thing is, another example of non-economic market participants is window dressing. So mutual funds have to disclose their holdings each month end. And so, let's say I'm trying to say Amazon. So if you were holding Amazon during this the pandemic, you would look quite clever. And so obviously the mutual funds, like even if they didn't own Amazon throughout the period, they want to look like they weren't kind of on the ball, so to speak. And so what they will do is that they'll buy Amazon right before they have to report their holdings, and then like sell some of their losers. And so you can take advantage of that by buying the ones that the mutual funds are selling at a more discounted price. Okay, so now let's look at the third area for generating alpha, and this is investor constraints. So this is where, actually, let me roll back to one more example, because I like to give you examples that are relatively current and timely. So let me give you another example. So we talked about the Fed introducing all these various programs, and I mentioned that they introduced a program for buying back corporate bonds and investment grade corporate bonds, and this is the first time that this ever happened. So what happened was, like I mentioned, that the coronavirus happened. All these companies, businesses were curtailed. It looked like they may not be able to generate enough revenue to pay their interest and all those kind of stuff. So what that meant is the price of their bonds dropped significantly, and so in other words, the yields for these bonds widened significantly. And so then the Fed comes along and announces a program that they will buy corporate bonds. So that has the effect of you want to do the exact same thing. So if you're going to either anticipate that announcement or even after the announcement, then your strategy would be to buy those investment grade bonds. So you could buy like an ETF of bonds, and in anticipation that the Fed will be buying back those bonds. And you could even be more sophisticated than that, because that the program was announced that it was buying investment grade bonds, but not high yield bonds. So if you want to be a little bit more sophisticated, you could go long the investment grade ETFs and short the high yield ETF, and maybe even do it in a kind of a market neutral way, given that high yield is more volatile, so you could volatilely adjust it. So maybe you would go long for every $2 long in investment grade bonds you shorted $1 of high yield bonds, just to give you the intuition. So yeah, so there's a very timely example of taking advantage of non-market participants, because the central banks, they're just motivated to rescue these companies, whereas you're interested in actually making excess returns. So that's like a very nice example, timely example. So anyway, let me turn back to artificial constraints. So sometimes it's constraints on the investor. And so I gave the example that some investors are not allowed to own only allowed to own investment grade bonds. So therefore, when the bond gets downgraded, and by the way, I'm anticipating a whole bunch of downgrades due to coronavirus. So those are probably going to be coming pretty soon. So you're going to find a bunch of bonds that used to be investment grade getting downgraded to high yield, and the spread between investment grade and high yield is wider than it should be theoretically. So what that means is you can make excess returns by either buying these high yield bonds that are just barely out of the range of investment grade, and shorting the bonds that are just barely investment grade, as an example. Another one is bonds that are almost within the horizon for money market funds. So money market funds can only invest in short-term debt, so debt that's less than 13 months. So this is why you see the yield curve kind of having a lot of curvature around that 1 year point. And so what you're able to do is you can buy let's say buy a bond with 1.5 years to mature at let's say a yield of say 200 basis points, and then wait for a few months till it rolls into the window, and then sell it to a money market mutual fund at say maybe like say 170 basis points. And so and you can imagine like I said, that these ideas that are not like it's not just one single trade. Like you could repeat this over and over again. So you could always be holding slightly longer bonds and then selling them to mutual funds and recycling that capital. So as long as you can do that like efficiently, so in other words, you're not paying too high bid-ask costs, that would be a strategy. Yeah, and then we talked about this one a couple of times, so that some investors are not allowed to use leverage. So what you should be able to do is take low volatility and low beta securities and put that into a portfolio and leverage it up so it has the same market risk as the overall index. And then if you go long that leverage portfolio and short the market index, that should also be a source of alpha. And that's exploiting that investors are not able to use. Some investors are not able to use leverage. So yeah, let me make a little bit of commentary on. So out of these strategies, which ones would you be able to exploit as individuals? So maybe you could. It's probably the bid-ask spread is going to make the idea of buying slightly longer debt and selling it. It's not going to work for retail investor because the bid-ask spreads will be a little bit too high. So that's probably not realistic, but definitely institutions would be able to do this. You as a retail investor are not able to get cheap leverage either. So you actually are on the other side of this trade in the sense that you guys will be in the camp that you're constrained to use leverage. So this trade will probably not work for you as a retail investor. The investment grade bond one, so you could use it to kind of tilt your portfolio a little bit, so that if the opportunity came to buy like investment grade, or sorry, bonds that have just fallen out of investment grade, maybe you could buy those every now and again for your trading account. But it's again, it's one of those markets where, like I said, that your broker probably won't have a big inventory of this, and also the bid-ask spread is going to be pretty high, so you may not be able to capture this kind of arbitrage. Whereas definitely institutions will be able to capture this. Yeah, so let me contrast that with some of the ideas that you could exploit. So, you guys are easily able to identify disruptive changes. In fact, you guys as retail investors and younger people may be even in a better position to identify these disruptions. Because a lot of times you'll find younger people will be using these services like Uber and Airbnb even before institutional investors are even aware that of these things exist. So like you could wonder like how many institutional investors know what TikTok is. I would bet not very many. Whereas I happen to know a lot about TikTok. That's another topic. But anyway, I'm sure you all know that it's a very valuable Chinese company. So there's an example of you guys like have an advantage because you're young, you're aware of new things, you're able to move quickly, and you should be able to have the ability to identify disruptions earlier than more conservative institutions. So I think that this is very much a place that you guys could look for outperforming in your personal accounts. Yeah, this behavioral finance one, I could very easily see somebody doing this, like kind of selling options and collecting premiums, and just so long as you're aware of the tail risk of that strategy. So if you have some good risk management experience and you have some good discipline in terms of bid-ask spreads, and you could easily make money doing this. Like I said, index rebalancing probably not. The central banks, I gave you an example that you could have done this quarter. So again, I think that's accessible to retail investors. Yeah, so let me carry on with constraints. So we talked about investor constraints, but then there's also sometimes there's market constraints. So sometimes like currencies are pegged, and sometimes the currencies will be under attack, and sometimes they won't be able to support those pegs. And so if you can anticipate those events, sometimes you can make a lot of money. There's a very famous story. It's quite an old story, so it's probably like way before your time. But even I'm not sure of the details. But George Soros is still around, very well-known name, and he was essentially like a global macro hedge fund manager. And I believe the UK pound was linked to gold, or sorry, linked to silver maybe, and then he was betting that they weren't going to be able to maintain that link, and so he bet that the pound would devalue once that link broke, and he turned about, his timing was very good, and he was right, and so he made a tremendous amount of money. Like back in those days, like if you'd done it in like today's terms, it would be probably billions of dollars worth of profit in that trade. So you guys can obviously go Google it, or I'm sure there's like a good wiki page explaining the trade. But anyway, those are probably pretty rare and far in between. Another one is regulatory capital relief trades. So this is something that you guys might have been exposed to in terms of your work experience, but you probably know as a retail investor, is not accessible to you. But it's the idea where a bank will have a book of loans, and these loans obviously are to customers, and they want to have good relationships with those customers, but that loan portfolio is using up too much risk, so they have to set aside too much capital for it, and which means that they're not able to make new loans. And so they don't want to annoy their customers by turning them down for loans or selling the loans to somebody else. So what they will do is they'll do like regulatory capital relief trades where they'll sell say the first loss on that portfolio of loans to a hedge fund. And because the bank is, this is almost like an example of like a non-economic participant, in the sense that the bank is not purely motivated by the economics of the trade, whether they're looking at it as the freeing up new capacity, business capacity. So they will be willing to do those trades with hedge funds at attractive returns for the hedge funds in exchange for taking on that tail risk. So there's like an example of like a hedge fund strategy that's easy to understand, but it's just not accessible to either institutions or retail investors. Okay, and then the fourth out of our fifth sources for looking for uh, um, market inefficiencies is arbitrage relationships. And so these ones are obviously quite mathematical because you've kind of got like an equation that should hold, and then the equation is being violated, and so you can take advantage of that. So a classic example, this was the impetus of the convertible bond market, convertible bond arbitrage strategy, or convert arb, is it more colloquially known. And so companies that were smaller and more risky and less well known, they would want to issue. So they wanted to issue. Um, they wanted to raise capital, and so maybe if they didn't want to sell equity because it meant that they would have to sell equity too cheap, but and so they don't want to dilute themselves. So so what they would do is they would sell debt, but the debt would be convertible into equity at a certain price. So there's a certain like attraction to the issuer for issuing convertible bonds, and then it was attractive to the investor because you get like a bond, but then it has you as a bond investor, you get the upside potential if the stock actually or the company actually does well. And so that optionality is like an embedded option, and as you know, that option can be valued. And it turned out that the market, for whatever reason, wasn't properly pricing these options. So some hedge fund managers or traders at the very beginning came to that realization. And one of the very famous ones was a guy called Ken Griffin, and I believe he was an undergrad at Harvard, and he was trading out of his dorm room in Harvard. So some famous story, and he realized that these convert bonds had this cheap embedded option, so he would be buying these convertible bonds and hedging out the option piece, and so capturing the option value, and not taking on market risk. And so he was earning alpha due to the mispricing of the bond or the embedded option, and that was the starting point for a very famous hedge fund called Citadel. And in fact, Ken Griffin is one of the people that's always on that top 10 highest paid hedge fund managers. So yeah, but obviously as markets got more efficient, they were able to price the bond or the embedded option properly, and so that arbitrage went away. And then you had to have more sophisticated trading strategies. Just as an aside, what was actually very interesting was to read some of the papers at the time that were talking about the strategy. And this was before that it was kind of well known that the bonds were mispriced, and they were coming up with all kinds of reasons why this idea would work, and none of them were that the option was mispriced. So it was pretty funny, like all the ideas that people came up with, and you think, well, it sounds kind of reasonable, but it's not really the right answer. Let me give you another example of like an embedded option. So I'll give you an example from teachers. So teachers, before the financial crisis, was trying to do a leverage buyout of BCE. And so a leverage buyout means that you use a lot of debt to take the company private. And so it's a much worse credit quality after the leverage buyout. So obviously the debt holders do not like this leverage buyout because it makes their debt worth less money. But what happens is and obviously there's BCE had a whole bunch of debt outstanding because it's a big company. They issued debt at different times, and they issued them under different prospectuses. And so some of the bonds had what was called a material adverse change clause. Sometimes it's called like MAE, like material adverse event, but whatever. So it's the same thing. So what the material average change said was that if there was, some of them said that if there's a buyout of the company, then you're able to sell your bonds back to the issuer, in other words, BCE, at par. So let's say BCE's bonds were trading at 90 cents on the dollar before the leverage buyout was announced. And then the leverage buyout was announced, and then the bonds would all drop to say like 75 cents. But then people started to realize that there's like some of them had this material average change. And so then all the ones that had the material average change clause, they all went up to like, 98 cents because they could be sold back to the company for essentially for a par. And so there was like a great example of like an embedded option that it was like, it's rare that it comes up. But let me tell you that though, there are hedge funds out there, credit hedge funds, and this is like literally what they do is that they will read through all the prospectuses of the bond issuances and look for like slight differences in the legal languages and the various clauses and covenants and all those kind of things. So so some people actually do pay attention to those. Then actually, I think I talked about the sum of parts when I talked about real estate. And so I gave the example of Loblaws and Canadian Tire being unhappy that investors weren't giving them the credit for their real estate on their balance sheet. So what they did is they said, okay, fine, we'll spin off that real estate into a REIT. So now instead of Loblaws, the old share, and now the Loblaws is like the pure grocery business plus a share in a REIT. And so that sum was more valuable than the whole. Or sorry, so yeah, the sum of the parts was more valuable than the whole. So there again, that's an example of something a retail investor could easily do. So you could have bought Loblaws before the spinoff. What you could also have done is you could have said, oh, okay, as soon as that idea was announced by Loblaws, or I can't even remember who was first, but you could look around, okay, who else has a lot of real estate on their balance sheet, and then buy those shares in anticipation of those spinning out a REIT. So this is an example of with a little bit of intuition and detective work, you guys could generate alpha as retail investors. There's another very famous one, which is Palm 3 and 3Com. This is, again, this is going to be something before your time. Like this is like pre-iPhone, but I believe that the parent company was, I can't remember actually who was the parent and who was the child. I think the parent was 3Com and the child was Palm, and then they had like a handheld device. And so 3Com was going to spin off the Palm as a separate share class, or as a separate share. And because it was like the Palm device was so popular at the time, it was almost like the iPhone IPOing, like that's kind of the equivalent. And because it was such a small amount of shares that Palm was that 3Com was selling, so maybe like 5% of the shares, and like 3Com was going to hold 95% of Palm, something like that, just to give the example. So there was a small number of shares available, and there was a huge demand for it. So you can imagine what happened is that the demand for these shares drove up the price so high that it meant that the remaining price of 3Com actually went negative. So obviously the arbitrage opportunity for that was just to buy 3Com, because the value of 3Com's Palm holdings, hopefully I got the order right, was much more than 3Com was trading at. So that was like a very famous example. There's another example actually too, which was that you guys may is more in your recent memory, was Yahoo. And so Yahoo was an early investor in Alibaba. So so what that meant is a lot of the value of Yahoo was actually because Alibaba did so well. So a lot of the value for Yahoo was actually due to the Alibaba ownership. And again, it was another example where the value of the rest of the Yahoo business actually was negative according to this arbitrage. So, and actually, this is a good example because this is one that I did myself. So I bought Yahoo shares, and then because of this like arbitrage opportunity, and it worked out pretty well for me, and so it was a little bit confusing because eventually they spun off the Alibaba shares into this like weird tax structure because they didn't want to like somehow they wanted to avoid paying avoid the capital gains, and so then I got these weird spun off shares, and like I can't remember what happened, but anyway, Alibaba did well, so that's all that matters. And, so there's another example. Again, like I like using these examples of where you as like an individual investor can do these trades yourself, and you know, like I keep saying, like this course is full of gifts, and these ideas are more gifts for you guys. So beyond your degree, you can actually make some money. Cross market arbitrage. Yeah, so this is, we talked about the idea that private assets have a illiquidity risk premium. So the most typical process you see that is a company will go from private to public. And so, you know, you as retail investors probably don't have access to pre-IPO shares. So that's not kind of realistic for you guys. But you know, sometimes it works another way around too. Like it's much more rare, but sometimes you'll see a company get taken private. So the example I gave was like Bell, or sorry, BCE. If teachers had acquired it, it would essentially have taken BCE private. I believe Dell was taken private. So by I guess Michael Dell in 2013. So I guess Michael Dell believed that Dell as a private company was worth more as a public company. And the reason he felt that was because as a public company, you have to do all these regulatory filings, and then people have like quarterly expectations, and you have to meet these targets. And so let's say you have to meet these quarterly profit targets, but you need to like invest in like say a 1-year overhaul and some kind of like, you know, a project to modernize your computers or whatever, assembly lines, whatever it could be. But because you're a public company, you're not able to take that hit and spend that money for the longer term. And so sometimes companies will say, yeah, we're better off being private so that we can be not feel so much pressure from the capital from the public markets. Here's another example of like arbitrage is sometimes shares are listed in multiple exchanges. So BlackBerry used to be known as Research in Motion, is listed both in Canada and the US. Another example is that Vail is listed both in New York as a ADR, like American Depository Receipts, and it's listed in the Brazilian Stock Exchange, which is called the Bovespa. So what that means is that once they trade in different currencies. So that means that there's both the stock price change in the various markets plus the currency change, and there are you know, hedge funds. Probably now it's dominated by high frequency traders, but you can imagine like this is what like one of the things that high frequency traders will do is that they will monitor the price of the same security in multiple different markets, and anytime there's any deviation that's bigger than they can transact in, then they will arbitrage that. And you can imagine that that's one of those things that's like it's very profitable in the sense it's just kind of like, since it's an arbitrage relationship, it's kind of like, you know, guaranteed to make money because you just bought the share at one place, sold it another place, so you really don't really actually own the share for any length of time, and so it's very profitable, but it's also very capacity constrained. And yeah, I mean, there's another example, like if it's such a profitable activity that you as a let's say as an investor wouldn't even be able to get capacity in a program like that, because they would say, well, we're just going to run it for ourselves. Why would we share this? So that's why you see like these high frequency trading people are being like, kind of pretty secretive, because they don't want to advertise and attract money, and they just don't want to attract attention to what they're doing to have other people compete with them, and they just like focus on optimizing their software to be as like as fast as possible. So yeah, it's a very interesting subfield actually, and it's also interesting because it really doesn't have anything to do with investing. It's almost like it's a pure technology strategy. So you have people that are doing this have like no idea about investing, but yet they're able to make a lot of money in capital markets. But again, that's something that you may end up like working in. But as individual investors, I really doubt you will be able to take advantage of this. Then the other form of arbitrage is security replication. So for example, you could synthetically create like yeah, you can do this in a couple of ways, but let's say, because I'm thinking if you wanted to create a corporate bond, what you could do is you could buy a government bond and plus and sell default protection on that bond. So yeah, maybe the way I wrote it is easier to explain. So if I buy a corporate bond, that's essentially embedded in it is a government bond plus the risk of default from that company. So then what I can do is I can enter into a CDS contract and insure away the risk of that default. So I will pay, like, let's say the corporate bond pays 5%, then I can pay 1% annually for insurance against the default of that bond. And that means that I'm net earning 4%, but that package is equivalent to a treasury of the similar maturity. So that treasury should also earn 4%. Otherwise, there's an arbitrage opportunity there. And so there's an example of where you could buy the cheaper form and sell them expensive form. Again, this is something that is more for institutions because you would not, as a retail investor, you would not have access to the CDS market. Another one is like again, it's a little bit more exotic in the fixed income market, but there's this idea of like bond stripping. So that's where let's say you take a 10-year government bond that pays annual coupons. So government bonds pay semi-annual coupons, but just to make it easier, so it pays annual coupons. So you've got 10 coupons plus the principal payment at the end. What you can do is you can split that out into 10 zero coupon bonds. So 9 for the coupons and then one huge one at the end. So, and because it may be that investors may pay more for the 10 zero coupon bonds than they would pay for the overall bond. And obviously the trade can go in the reverse as well. So it could be that for some reason people don't want zero coupon bonds. So what you could do is go buy those bonds and package them back together into the original bond. So you could reconstitute that bond. So you could go like, let's see. Yeah, I'm just thinking, so you go long the whole bond and short all the pieces of it. Yeah, so you get the idea that there's various relationships, and if these relationships ever deviate, then you can take advantage of it. So yeah, let's keep going. So the fifth and last one we'll talk about is relative value relationships. And so there's the people use the term arbitrage and relative value loosely, pretty softly in markets. So, for example, there's a strategy called statistical arbitrage, which is almost like a contradiction in terms, because like an arbitrage shouldn't be statistical. What that really means is it's kind of like statistical relative value. Similarly, with capital structure arbitrage, it's really capital structure relative value. So it's not guaranteed that these relationships hold, but it's just that they should hold. So let me give you an example of like, capital structure, arbitrage, like arbitrage in quotes. So the idea is that a company will issue different types of debt, and some of that debt will be higher quality than other debt. So the highest quality debt could be first lien, and then which means that if the company goes bankrupt, the first lien debt holders have first claim on all the assets. And then second lien would be if there's any assets left over, then they will go to the second lien debt holders. And then if there's any assets left over after that, it would go to unsecured lenders. And then you could also think of preferred shares or preferred equity as actually as debt. So that's kind of like a little bit the middle ground, but essentially it pays like a dividend. And for example, if you suspend the dividends for the preferred shares, you're not allowed to pay dividends on the stocks. So it kind of acts as a little bit like debt. But anyway, the point is that the yield should increase as you go down in terms of the quality. So in other words, first lien should have a lower yield, and second lien should have a lower yield than secured, and finally the preferred should have the highest yield of all. And so anytime that relationship gets violated, then that's possibly a trade that you could do. So it's a relative value trade. So there's others of these relationships that are expected to hold. So that's where like secured yields should be lower than unsecured yields. So in other words, like repo yields should be lower than LIBOR. Government should be lower yields than banks. So treasuries versus swaps, for example. Governments should be lower yields than corporates. So treasury versus like Berkshire Hathaway. I think I picked Berkshire Hathaway deliberately because I think Berkshire Hathaway is AAA rated. And there was one example where Berkshire Hathaway yield was actually lower than government yield. But if you looked into it, it was just one of those weird things where it traded very briefly. And so it's probably like, some of the case where just somebody put in like a bid for some reason they really wanted Berkshire Hathaway debt and overpaid for it for some reason, but it wasn't like a systematic mispricing. Then here's an example that I really like: government versus provincial. So that means like Canada versus Ontario bonds. So there's an example like that's actually something that you guys could do, and which I do. It's like, instead of buying a Canadian government bond, I would just buy like provincial bonds, because essentially like it's from my point of view, it's the same credit quality. Like it's not like okay, this is just me editorializing, so don't take this as facts. But in my own opinion, I don't ever see Canada allowing Ontario to default on their debt. That's just not going to happen, in my opinion. So essentially, the Canadian government is essentially backstopping the credit quality of the provincial debt. So I'm quite happy to take that extra credit spread. So let me see. Yeah, actually another really good example of this arbitrage. So for you guys, it may not look so attractive, but if you guys know what a GIC is, so a GIC is a guaranteed investment certificate, and it's essentially the GIC can be issued by like a dodgy bank, but so it'll pay kind of like the yield of a dodgy bank, which is obviously higher than the government of Canada, but it's insured by Canada up to a certain amount. I think it's $150,000 or $100,000, something like that. But essentially, it's a kind of free arbitrage for people up to that limit. So again, it's another one of those examples where people are walking around with kind of these like unused arbitrages that they may not be aware of, like your TFSA room. And so this example. So for example, like let's say the 5-year Government of Canada bond is yielding, like say 70 basis points, but you can buy a 5-year GIC at say 170 basis points. So that extra 100 basis points is kind of, you can think of it as pure arbitrage, because you're getting the dodgy bank yield, but you're getting the Canadian government credit quality. So there's another thing that, like I know the yields are not that big, so it's not that exciting, but still, it's a nice, at least theoretically, it's a nice example of an arbitrage. Yeah, another one is like treasuries versus, so government versus government-sponsored entities. So again, it's one of those cases where the government is essentially stands behind Fannie Mae, which is like an issuer. Actually, I think they're an insurer of mortgages, residential mortgages in the States. But the point is that they will issue debt, and that debt is effectively guaranteed by the government, the U.S. government, and because of that, it should actually have really the same yield, but for whatever reason, either like a slight quality spread, either the chance that the government backs away from their guarantee, or they're slightly less liquid or whatever, but they'll trade at a slight yield, slight spread. So anyway, so the point is though that sometimes these relationships will either be violated, or they'll come close, or they'll be a lot either wider or tighter than you would normally expect. So for example, if the government of Ontario bonds all of a sudden we're trading at like a spread of 300 basis points, then that's probably like a pretty good deal. Whereas if they're trading at say just 10 basis points, that's probably not a good deal. So again, you don't have to wait for the relationship to be violated. You just have to wait for it to get kind of distorted enough that it becomes attractive. Yeah, and then there's statistical arbitrage, and this is it's a whole field in and of itself, and it's gotten more and more sophisticated. So it used to be that statistical arbitrage, where you just identify two stocks that were highly correlated, you'd watch them deviate slightly in terms of prices, and then you'd buy the expensive one. Sorry, you'd short the expensive one and buy the cheap one, and wait for them to converge. So like Ford versus GM, TD versus CIBC. And then you do that like all day long for all kinds of companies. So you can imagine that at any particular time, there's all kinds of these slight deviations, and so that's what statistical arbitrage exploits. So those like slight price discrepancies as a form of market inefficiency. But and obviously this is obviously going to be quite a secretive area, because people don't want to say exactly what they're doing. But these statistical arbitrage models have gotten more and more sophisticated, so probably like years ahead of what we can imagine. But there's things like there's this idea that leaders versus laggards. So that's the idea that let's say there's good news for tech stocks in general. So what happens is people will tend to exploit that by buying the most well-known names. So those would be like the bellwethers, so like Google and Apple. And then the other tech stocks will follow. So what you can do is you can do that timing so that, so let's say you would, after the leaders have moved, you would short the leaders and go long on the laggards in anticipation that they're going to catch up. So those just give you some like intuition about the types of trades, but really it's going to be like much more sophisticated. So all the stuff that Renaissance Medallion Fund does, that'll be like a lot of statistical arbitrage, just exploiting these weird statistical relationships. And yeah, so yeah, I told you this is one of those areas that I find most interesting. So I kind of spending a lot of time going on to it. So I'll wrap up and we'll take a break. So let me get to the next two slides. So we talk about stat arb. Then there's like convergence trades. So this is where the on the run US Treasury bond has a slightly lower yield than off the run because it's the most liquid. So everybody wants to trade the on the run. So you can use that as an arbitrage that you could sell the on the run and buy the off the run. So from your point of view, the difference between like a 10-year bond and like a 9.5-year bond, you don't really care. But if you can pick up a few extra basis points, then that's what you do. Another very famous example, and if you guys know the story of long-term capital management, but whenever the euro was announced, so what that meant was that the interest rates in all the European countries would converge to kind of like a common euro interest rate. And so let's say you had countries like Spain that had higher yields and countries like Germany, which have like lower yields. What the idea is as you got closer and closer to the euro being introduced, those rate differences should converge. And so there was an example of like an obvious convergence trade. So then what long-term capital did was they said, okay, we've identified this convergence trade and we're going to leverage it like 40 times. Like I'm just making up some number, but it's probably pretty close. So they take this trade and they leverage it 40 times by going long like the Spanish government bonds and shorting the German government bonds, and they just wait for the euro to get introduced, and then they'll just unwind that position. The problem was that the yields of the European countries didn't go in a nice smooth line as you got closer to the euro being introduced. Rather, they kind of wiggled around, and so what happened was that they diverged, and so instead of Spain yields getting lower, they actually went higher, and Germans got even lower. And so what that meant was that differential was magnified due to the leverage of long-term capital management, and essentially they blew up the fund. And so you would think that you know, it's a great example of very smart people doing very stupid things with the benefit of hindsight. So this actually, this is a little, again, this one was like, we're on a topic that I have a lot of interest in. So I can't resist telling you this little side story. So long-term capital, very similar to the Medallion Fund, they were very successful, made exceptionally high returns, and they said, yeah, we have essentially an engine to make money. Pretty much the same conclusion that Renaissance and Jim Simons came to, and they said, yeah, let's get rid of all the external investors and just run our own money and get like super rich. And so that's what they do, and then they blow up. So it's a great story in the sense that they blew themselves up, and so mostly they hurt they lost their own money, and so that's a nice aspect to it. And the only thing was, it was at the time, like relative today, it was like this is just like a blip, given all the other crises we've had. But at the time, there was some concern that it would like bring down some other like financial institutions, and this is like quite essentially a blow up. And then it gets even worse. And I think one of the people involved in it was I think was Merton, who won a Nobel Prize, and so you think that they would know better, and essentially that they claimed, yes, we're really good at risk management. Like this is what our expertise is, and then they end up blowing up. So then the story gets even more funnier. So they kick everybody else out, blow up their own money, and they're the Nobel Prize winners on risk management who blow up due to bad risk management. And then they said, okay, let's try it again. So they get together and do the same thing. They blew up a second time. And for some like Japanese spreads blew up on them. And you said, oh my God. And so, yeah, and I think they started a third time even. And then I think this at that point, probably nobody else wanted to allocate money to them. So I don't know how they're doing. But yeah, it's just like it's like, you know, if you find these things entertaining, it's a really funny story. So anyway, I want to continue giving you trading ideas. And this is actually one of my favorite ones. It's closed-end fund discounts to net asset value. And so this is the idea that you guys are not familiar with an ETF. An ETF is an open-ended fund, which means that the ETF always tracks its net asset value pretty closely because you're able, like not you individually, but some people are able to take the underlying securities in the ETF and hand it over to the ETF provider and say, please give me some ETF units, or they can do the reverse. They can take the ETF units that they own, hand it back to the ETF issuer and say, please give me the underlying securities. So that kind of arbitrage mechanism always keeps net asset value close to the market price. So that's a very nice feature. And so that's great. And also because it solves like liquidity issues, because like also as well, because if there's more demand for the ETF, they just issue more shares, and if there's less demand, they just like collapse the shares. So it all works beautifully. But closed-end funds are kind of the opposite in the sense that they trade on the exchange, so just like ETFs. But the thing is, there's only like a finite amount of them, and you're not allowed to trade them back in. So what that means is that these can trade at a discount to their net asset value. And so some of that net asset value discount is due to the management fees. So these things charge like excessive management fees. So that's like not good. But sometimes you can buy it at such a discount that you're essentially buying like, say $1 worth of assets for 80 cents. And so let's say that $1 worth of assets gave like a 4% dividend yield. So you're able to buy that $1 worth of assets with only 80 cents. So you're actually getting like, I can't remember the number I gave, but like what I say, like 4 cents on the 80 cents. So which is a 5% yield. So essentially you've leveraged yourself, like at the very least, you've leveraged yourself up the yield. And also too, that sometimes this discount can get reduced. So either some reason that they decide to wind up the fund because the discount is too low, or for some actually there's some investors that follow a strategy of actually trying to force these closed-end funds to essentially close down. In other words, to exchange back the assets because the discount is too big and there's too much of an arbitrage. And also there may be special days where you are able to trade in the underlying shares. So they watch for those special events. But anyway, you as a retail investor, so these closed-end funds, they're usually too small for institutional investors to look into, but they're just the right size for individual investors. And there's actually websites in there that you can track the discount to NAV. So you can buy closed-end funds that's selling at an usually high discount. There's also an ETF of closed-end funds. So if you're too lazy, you can just like buy the ETF. But it's more fun to like kind of look for your own. So, and again, this is like a trade that I've done in the past. Like, like I was like, sometimes like you're at work and you're too busy to look at things but whatever. But like when I had more time, this is something I did kind of, for half for entertainment and half for generating alpha purposes. So again, that's something that's easily available for retail investors. And I guess very much that idea that you as a retail investor have disadvantages, but sometimes you have advantages too, in that you're able to look at things that are just too small for institutions. Yeah, and then the last thing I want to show, and I think you guys will get this idea quickly, but a lot of these relationships you're really just tracking them and plotting them on a in a kind of sigma graph, and you're looking for like 2 sigma deviations one way or the other. So in this little diagram here, let's say this tracks the deviation between like 2 securities, and so it's kind of at where it's expected, and then it goes 1 standard deviation, but that's not enough to trigger a buy or a sell. Then it kind of reverts to 1 standard deviation the other way, and then it crosses the 2 sigma deviation. So you use that as a signal to buy the cheap one, sell the expensive one. The trade goes against you for the first while, because it blows out to 3 standard deviations, but then it starts to come back again and mean revert, and then it passes through. And so then maybe you have a signal that you cover the trade at, say, at 1 sigma the other way, and then it goes. Then you monitor again. Oh, and then it triggers like entering the position the other way, and then you hold on to it. So the point what I'm saying is that there's these literally these thousands of relationships that you can be monitoring, and it's almost like there's so much information that it's almost you have to choose what you want to specialize in, and you can imagine that these hedge funds just like look at everything. But yeah, I mean, you could choose to specialize in certain aspects and monitor these relationships, and you could have your own definition of what a deviation that would trigger a signal, and you have a choice of what kind of time windows you want to use. Like you could do something like a 5-day moving average crossing over to 30-day moving average. And so yeah, I guess the spirit I wanted to get across to you was that it's actually a very exciting space if you're interested in investing, because there are so many ideas that you can exploit and look for these kind of opportunities to generate alpha. So both in all kinds of aspects, both as an institutional investor or as a retail investor, or maybe even like in a third category as like a software developer, coming up with these quant models that aren't even linked to investing. Okay, that was taking up a lot of time. So let me stop there and see any questions, and then we'll take a break. I unmuted everybody, so if anybody has any questions.
I have one more question relating to the assignment. I know you already covered a few of them.
Yeah.
It was just on the last point you made, in the sense that someone asked if you had to actually backtest it, and you said no, not necessarily. Time constraint.
Yeah.
But then my question to that would be is, like, how do we show that our strategy would actually work, or like over a 5-year time period we don't blow all the money, and in the 1 year it works? Like, how do we like show that if we don't do some sort of back testing, like if we don't have to build that framework from scratch?
Yeah, so I think I even addressed this in the email that I sent you guys, giving you suggestions. But so one idea I gave you was to say use the return of the S&P as your kind of independent variable, and then the value of your option strategy as a dependent variable. And then you kind of graph like very simply the payoff for your option strategy as a function of the S&P. And so that will be something that you wouldn't necessarily need to do any backtesting for, but would give you an idea of the payoff. And then you could take it to the next level and say, okay, well, that's kind of a static model, but my strategy has kind of dynamic ideas embedded into it. So I may not be, my option strategy may not be a simple function of the S&P return. So maybe it's a function of the S&P return and the trailing 1 year return, just to make up an example. So either what you could do is you could plot multiple curves, giving like different scenarios. So you could say, here's the baseline curve. Here's a curve if the last year's return in the S&P was, say, low, and here's one where it'd be high. Or you could be even more sophisticated, and you could say, let's say your strategy had like 2 variables, so some kind of concept of valuation and return on an S&P, you could plot that out as a surface, and then you could start analyzing, your strategy based on that. So there's all kinds of ideas where you don't actually need to do a full back test. Now, what I'm suggesting, and the link to the backtesting, is what the backtesting will provide will be a sense of the weighting for that curve. So let's go back to the simple example of a curve. So I just say, here's my option payoff as a function of the S&P return, and you know what that's going to look like. It's going to look like one of these like kind of like like a sloping line, and then like flattens off, like the classic hockey stick payoff thing, right? But what that graph is not going to tell you is what's the probability of landing in those different regions. And so then you could either, so let's say you wanted to address that aspect. So what you could do is you could start shading that simple graph by kind of like probabilities of areas. So you could say, okay, 2/3 of the time the S&P is between like -5 and +15, and so you color that area for your graph, and then you say, 5% of the time it's like -5% or worse or something, and you color that graph, and then now you can kind of come up with some kind of probability weighting of the expected payoff of your option strategy. So let's say, to carry on that example, so let's say 10% of the time your option strategy pays off like +8%, and 90% of the time it costs you 2%, or I don't know, 1%, whatever it is. So then you could come up with the expected payoff of that strategy. So there's lots of ways that you can just like report your results in a way that's understandable. So remember, like the idea behind this is that you're making a recommendation to senior management, who's not going to be interested in so much all the details of your backtesting and quant and whatever. So they want it explained to them in a way they can easily understand. And so if you tell them, yeah, you've got a 10% chance of making 8 times your money in a market crash, but that's going to cost you like 1% of the fund return or something, they could kind of get their head around that explanation. So I'm kind of saying that if you want to do the full backtesting and you have time for it, then go right ahead. But even if you do that, you need to summarize your results in a way that is understandable for management. And so then what I'm saying is you could actually skip the backtesting step, recognizing that it's probably complicated to explain, and just try to think, okay, how could I explain this in a way that senior managers could understand? And senior managers can kind of understand, kind of 3 scenarios, like good, neutral, and bad. And you can say, okay, the bad scenario happens this amount of time, and this is what happens in the bad scenario. Or you could say, like, the average cost of my scenario is the average option premium I'm spending is like 50 basis points because I was very clever in how dynamic it is for these rules when I buy and sell and monetize a hedge, and I end up getting like a 4 times payoff in a tail event. So that's what I'm saying. Like you don't necessarily have to get to the full backtesting step. You can kind of apply some high-level intuition on how you want to describe your strategy. Does that make sense?
Okay. Yeah. Thank you very much. That helps.
Okay. So any questions? So like I give you like a 2-hour lecture on like all these trading ideas, and like you don't have any questions? You want to say like, okay. So I guess I'll leave it for you guys to sleep on, and because I kind of half expect you guys to say, oh, I'm gonna like just quit this course now and start my own hedge fund. But I remember I gave a lecture at Rotman, and this was at the time where like cryptocurrencies were just taking off, and like I was talking about like also marijuana stocks were taking off at the time too, and so like amongst the young people, this is like the super popular things. And this was like, I think Ethereum was, when I was putting my notes together, I could think Ethereum was like $10, and when I gave the lecture it was like $50. And then I guess you guys know what happened afterwards. But I kind of joked and I said, yeah, like investing in marijuana stocks and cryptocurrencies is really fun, and you could probably like drop this class and start doing it and making a lot of money, but it's not asset management. And so it's kind of like, it's similar to this, that yeah, like all these ideas for trading ideas, it'd be a lot of fun, but yeah, it's like it's not traditional asset management. But anyway, okay, so we went on quite a long time. So well, let's take a break till 8:30, and then we'll come back and I'll cover the currency hedging, and then I'll cover the exam question, and maybe, and probably like tomorrow, since we've gone like worked pretty hard this night, maybe we'll take it a little bit easier for tomorrow's class. Okay, so I'll see you at 8:30. Okay, let's get started again. So I'll spend, say, probably 15 to 20 minutes on the rest of the slides on market hedging and currency hedging, and then I'll spend the last 10 or so minutes on the exam question, and that will take us to about 9 o'clock. And then, like I said before, and we'll skip the case for today, and I'll give you back an extra break tomorrow. So maybe we'll try to just end tomorrow at 8 o'clock. So yeah, in exchange for working so hard today. So let me go back to the slides so we can keep going. Okay, so this is essentially the content of the case anyway. So when we want to hedge market risk, I want to distinguish between a normal market risk and risk in the tail hedge, and so the first first thing to think about, or the first thing that protects you from let me actually just step back. So the perspective we're taking is we're trying to avoid the large market losses, and even like losses during a crash. So that's the kind of the mentality. And so then we ask the questions, well, what can we do to manage that risk? So that's the kind of the risk from modest to large market drawdowns. And so the very first thing is, just to state the obvious, it's having a good portfolio construction. So in other words, you don't have all your risk in equities, for example. You have like things that are risk off types of assets like gold and US dollars and treasury bills mixed in with your risk on type assets. So just keep that in mind. And then the other one is liquidity and the ability to liquidate. So let's say you feel that you're taking on, your portfolio is taking on too much market risk. So instead of trying to think of to do something complicated, like put on like a tail hedging strategy or hedge your risks, keep in mind that you always have the choice of just selling down that position or selling some part of your portfolio to reduce that risk. And so keep that in mind. That might be the most efficient thing to do. So another message is just to don't overthink things. And then the next line of defense is if you feel that you're uncomfortable with the amount of market risk that you're taking, is to put on like a hedge. So for example, you could short S&P futures, or you could short the high yield CDX index. So and the reason why I pick high yield is just because you're looking for something that will lose a lot of money in a market downturn, and so that's typically things like equities and high yield credit. And so you want to short those things to hedge the market risk in your portfolio. So yeah, it could be that maybe you're not able, maybe you've already constructed your portfolio and you've got like illiquid assets like private equity, infrastructure, private loans, and so you're not, liquidating is not an option. So that's where you say, well, maybe I'll put on some linear hedges. And the downside of linear hedges is that obviously it's like if the market goes up, you're going to lose money on those hedges, kind of one-for-one relationship. So to avoid that, losing money, even under scenarios where the market is typically just like behaving normally, you could say that instead of doing linear hedges, you could put on a tail hedge. So you could buy a put option. So in other words, you pay a premium upfront, but in exchange for that, you're protected for the cases that you really care about, or the case that you really care about, which is a large market drawdown. So in other words, you don't really care about, like, small fluctuations here and there, like up or down, a few percent. That's kind of normal, but really you don't want to have, fat tail drawdowns. So then that would be the next thing you could do. Then if you want to get maybe more sophisticated, then you could use strategies such as trend following, which is what managed futures and global macro strategies typically do. And so you could pay an external manager to have them run a strategy that should pay off in a market tail event. And the advantage of doing that, as opposed to just paying an outright option premiums, is because hopefully these managers are generating enough alpha during normal times that it covers the cost of the option. So in the ideal world, you kind of get this tail hedge protection for free, because you get the alpha covering for the premium cost during normal times, and then you get the payout in a market crash. And then the final thing is a dedicated tail hedging portfolio. And sometimes that can be done by like an external manager. So they're pretty rare, but they're called like black swan funds, and they're designed to pay off tremendously in terms of if there's ever a market crash. So they will have a whole bunch of deep out of the money options on in various different asset classes, and with the idea being that they will typically be a minor drag during normal periods of time, but whenever the crash, they'll pay off significantly more than like a typical tail hedging, like option tail hedging strategy. So you're paying the manager for their expertise in constructing these like tail payoffs. So maybe they wait around for buying protection when it's particularly cheap, and buying protection on markets that are so that they can buy so whenever you buy the tail hedge protection that's cheap, it also, like, that's kind of implying that you're buying tail hedge protection on expensive assets. So they do a combination of those things. So they look for cheap tail hedges, and they look for tail hedging on things that are expensive. So there's more upside if they do crash. And in terms of this list is ordered in the way of frequency of institutional investors actually using these strategies. So everybody does portfolio construction. Everybody has maintained some kind of source of liquidity. Now, some places may use hedging. Even tail hedging strategies at institutional investors are pretty rare. Having a managed futures in the role of a tail hedge, that's theoretically, I've only seen this discussed theoretically, so it's like theoretically very nice idea. But what it means, what would it mean is it'd be allocating, say, like 5% of your portfolio to a basket of global macro managers or managed futures managers, and I just don't see institutional investors doing that. It's just too big a size in one strategy, and so rather their entire hedge fund portfolio maybe 5 to 10%, and then within that there might be like a sliver for managed futures and global macro. So it's more part of the value add program, but it's not. They're not done in a size to hedge the overall portfolio. And then this idea of dedicated tail hedging funds, like black swan funds, it's the same thing. That they sound great in theory, but in practice, you don't see institutional investors really having allocated to them like for example, I don't see many stories where investors saying, yeah, we were invested in this like black swan fund and it really saved us during this crash. I think I sent you a link in your assignment talking about CalPERS and how CalPERS actually had invested in a couple of these tail hedging or black swan funds, and it turned out that they'd actually redeemed them I believe as a new CIO came in, because he didn't believe in that approach, and it was rather embarrassing because the timing was terrible, and because the CalPERS board thought that they were investing in these tail hedging or black swan funds, and then they found out that actually it turns out they weren't invested because they got it redeemed right before the coronavirus crash. So I think I shared that link with you guys. Keep track of the time. 8:40. So that's everything I want to say for market hedging. So let me turn over to currency hedging. Oh, actually, no, let me show you some of these graphs. So yeah, so I want to distinguish between the normal hedging and tail hedging. So in tail hedging, what happens is there's this phrase that all correlations go to 1, which what that means is that everything either behaves as risk on or risk off. So all the risk off asset classes are fully correlated, and all the risk offs are correlated to each other, and all the risk ons are correlated to each other. So that means like risk on asset classes like equity and credit all crash, and risk off asset classes like US dollar, gold all rally. And so whereas that's what happens in the tail, but it's not what happens in normal times. So yeah, just keep that in mind. So really, when we're talking about hedging, we're really focused on how did the tail behave in a market crash. So what I show here is this idea of using managed futures as a tail hedge, and here's all these various crises, and then it shows the black bars are equity crashes. So, and it gives kind of like, the cause of them. So for example, the worst case was Lehman's bankruptcy during the global financial crisis. And so then they show that the managed futures tends to be positive return in these types of crashes. So you would have made 4% in managed futures. So the idea is that it's more of a statistical hedge, meaning that it's not guaranteed that it will work. Like for example, this double dip fear, it actually didn't work. The Bosnian war didn't work. It didn't act as a hedge. Also, you don't know exactly how much it's going to pay off. So in 9/11, it only paid off a small amount. The GFC, it only paid off a small amount. Whereas in the Nikkei weakness case, it more than paid off. Similarly, like this other case, what's interintention? I don't even know what that is. But anyway, so unlike a tail hedge, unlike a put option where you know exactly what the payoff is going to be conditioned on the equity return, you don't know how much the managed futures is going to pay off. On the other hand, though, you don't pay an upfront premium. So that's the trade-off. This is telling the same story, but then you may be wondering how these managed futures managed to earn a positive return during a crisis. And so kind of like the first 2 hours of this lecture, hopefully I opened up the box for what hedge funds do, so it doesn't look like that mysterious. And once I went through like all these different trading ideas, you should kind of get the sense that, oh, if I walked into a hedge fund, I could kind of understand the types of things that they're doing. So similarly, I want to kind of give you an idea of how managed futures act as a hedge. And so managed futures are trend following. And so I think I've talked about this before, but as soon as the market starts establishing a trend, the trend following will pile onto that trend. And because managed futures trades in futures, where it's just as easy to go long as it is short, so they're kind of really indifferent to being long or short. Whereas in like cash markets, it's much more awkward to go short than it is long. But that's not the case for futures. And so what they will do is, as the market starts to trend downwards, they will short the market, so that they will follow the market kind of in the inverse when it's going down, and they will also follow the market when it's going up. And so that's the way that they manage to make money, both during normal times and also make a lot of money in crashes. Because during a crash, the trend is very strong, and so they would be positioned very short throughout a crash. And so what this graph is showing is just showing what like a trend following strategy or momentum type strategy would look like. So in case that you didn't even like you wanted to run your own tail hedging program, you could do this yourself. And so it does a similar thing. It shows like how the blue lines are the payoffs during various market stress events. And this one goes back actually back to 1900. And it's interesting, it uses the 60/40 as a reference. So was a previous one just used pure equities. But anyway, it's a similar concept. And you may not have noticed, but this research is from AQR, which is, you saw the video clip from Cliff Asness. So he's the founder of AQR. And in fact, he runs a program, essentially like that's meant to be a tail hedging type program. So investors could allocate to that if they want to kind of have this kind of protection for the portfolio. And yeah, actually another just little factoid is like Cliff Asness from AQR and a guy called Nassim Taleb, who's a big, he actually manages, or actually either manages or advises one of these black swan funds. But he's I think he wrote a book called Black Swan something. But anyway, they're both interested in tail hedging, and they're both like having a little feud on Twitter. So this kind of like, you know, a little topical story for you guys. But they're feuding over tail hedging. It seems rather an unusual thing to feud about. But anyway, so I want to keep moving. So I want to talk about currency hedging. And the thing about currency hedging, the main thing I want to get across is that as Canadian investors, we have a currency that's linked to oil, as I've discussed before. And so we have a risk on type currency. So for Canadian investors, it's not so clear cut whether we should currency hedge or not currency hedge. And because of that, you see institutional investors, some of them will hedge, some of them will not hedge, some of them will split the difference. And some will actually change their minds over time. And remember, like CDP was fully hedged, and then they lost a lot of money in margin calls. So then they stopped fully hedging. So the one thing as a Canadian investor, like I said, if you don't currency hedge and you buy U.S. assets, then you are long a risky asset or risk on asset, which is equities, but you're also long a risk off asset. So there's a natural diversification benefit to that package of being long US dollars and also long US equities. And so because of that, it's not so obvious that tail hedging, currency hedging, sorry, is a good thing for Canadian investors. And the answer may be, well, the answer probably like could depend on the correlation between the risk on and risk off. And so maybe the size of the currency hedging would be a function of that correlation. So those are some things to think about. And then I just want to show you that there are ETFs out there that are currency hedged versus not currency hedged. So we can look at the return of the, like let's say there's a Canadian dollar ETF that tracks the S&P that's currency hedged, which means that the Canadian investor should get the local returns of the S&P. And then you can compare that with the actual like returns of the S&P in US dollars. And then you can ask, okay, is the currency hedging effective, or does it cost money, or what? So that's what I show with these graphs. So what I'm showing is the S&P 500, which is the US ETF. I believe it's the largest ETF in the world by 8 assets. So it's very good. And then I show the XSP.to, which is S&P 500, but hedged back to Canadian dollars. So it's denominated in Canadian dollars, and it's also hedges the underlying S&P 500. And so you can see this range here is from 5 years from up till 2019. So this is the slide I showed last year. And so you see, yeah, oh, it's a very effective currency hedging. It works great, no problems. But then I updated the graph to this year, and then actually it doesn't look so good. So there's the S&P 500 actually outperformed the hedged Canadian hedge version by 7%. So it looks like there's kind of like been some kind of drift in the currency hedging. So it's probably likely when there's large movements in the Canadian dollar that there's some slippage in the hedging. And then just to see if it was as something to do with the XSP specifically, I also graphed another ETF from Vanguard that is also Canadian hedged and tracks the S&P. So it's pretty much identical to XSP, and that also has the same behavior. So it's nothing specific to the ETFs. So it must have something to do with the volatility of the Canadian dollar recently. So you can see how currency hedging can be expensive. So or at least introduce some tracking. And this is just a warning to just be careful when you analyze your data. It's almost like the message I gave you from the very first assignment. So this is the S&P 5, the same XXP versus S&P for the full lifetime of the XSP ETF. And you notice that it actually does a really bad job of tracking to the currency. But this is one of those things where you have to be careful because the ETF actually changed its strategy. So prior to 2005, it wasn't currency hedged. So you just have to be careful for things like that. So here, what I do is I graph it from the time that it is properly currency hedging. So this slippage here is then the lifetime slippage on that ETF due to currency hedging, and so you see that it's about it's almost like it's 35 basis points, or sorry, 35%, but over what's that, like 15 years? So I guess like roughly 2% a year slippage, which is actually pretty expensive. So that's not that impressive. So anyway, that's something to keep in mind. So most likely, as Canadian investors, currency hedging may not be attractive because you lose the hedging effect of having US dollar exposure, and also just the implication of currency hedging itself has some expense and slippage. So the recommendation would be to actually avoid currency hedging. Okay, so let me, in the last 7 minutes, let me switch over to the question. Okay, and so that's some notes for the case, but you can skip that. Here's the exam question. And I wanted to, instead of giving you the answer ahead of time, I was going to like fill it in for you as we, on the fly. But let me just set up the question in the first place. So we've looked at all these different ways of managing a portfolio. So we talked about the Yale Endowment portfolio with David Swenson. We talked about all weather, or also like risk parity from Bridgewater and Ray Dalio. We talked about quant models with Jim Simons and the Medallion Fund from Renaissance. We talked about like factor investing. So like value and small cap and all that. And then we talked about fundamental stock picking and using Warren Buffett as the classic example. And then remember, we could attribute the returns for a portfolio to security selection, market timing, and market exposure. And so what this exercise is asking you to do is to say, okay, how much of the returns can be explained by these three different factors, or three different pieces, and use like high, medium, and low. So it doesn't mean that everything has to be high, medium, low, but it's just some kind of categorization. So For Yale, let's do Yale. Yale, remember that's a he wants to be exposed to economic growth. So market exposure definitely high. But also remember that Yale generates a lot of value add for by their private assets. So security selection is probably like a medium. You know, if you put high there, I would have accepted that as well. If you put small, I wouldn't have accepted it. On the other hand, though, because it's a liquid, there's not a lot of opportunity for market timing. So that would be low. The all-weather, that's another one that's pretty clear-cut that the market exposure is high. There's really no security selection, so that would be low. And market timing, you could argue a little bit about whether, like, you know, varying the weights as the risk change. So I would either accept medium or low to here. So I would put low, low, or maybe I'll just do it like this. So I would think low is a better answer, but I would accept medium. And here I would think medium is a better answer, but I would also accept low. Quant models. So there's another example, like a good example of the other case where it's all coming from security selection. So remember I told you that the medallion fund makes money no matter what the market does. So if the market is crashed, it still makes money. If the market is flat, it still makes money. So its market exposure is low, and there's like no other possible answer for there. Security selection is high. Market timing is it's a little bit subtle, but it's probably higher or medium. I would accept higher or medium, because if you're trading so many things all the time, it's hard to distinguish between whether it's security selection or whether it's market timing. So I'm pretty sure that Medallion is constantly trading the US S&P future, for example. But is it trading it as part of security selection, or is it trading it as part of market timing? The answer is it's probably like a blend of the two of them. Fundamental stock picking, that security selection is clearly, I put medium to medium or high. So you might be surprised that I don't put high there, but the thing is, the reality is Warren Buffett and fundamental stock pickers really track the market pretty closely anyway. So most of the returns come from the market still, but it's just they just add on top of that security section. And then market timing, that's a little bit tricky because there's some of the time like decision of when to buy and sell. So I would kind of accept like medium here. I skipped over factors, but let's just quickly knock that one off. Market exposure, it's obviously high. It's almost by definition, you're investing in factors. Market timing is low. And security selection, that one's a little bit ambiguous because you are kind of picking securities to express these factors. So I would maybe think like low to medium here. So that would be, I would consider it as the kind of model answer to this question. And also it's a great question to review at this point in the course because it's a nice summary of all the different approaches that we've got, and it's also a nice summary of all the different sources where returns come from. And it's nice to see like where the returns are primarily driven from, like how quant models are very different from say everybody else, because everybody else has high exposure to the market, and so they're kind of a little bit of an outlier. And so remember, like I said, asset management was mainly getting static exposure to market exposure because you earn a rewarded risk premium. There's fundamental economic reasons why you're getting rewarded, and it's essentially very cheap, low-cost exposure to access these market exposures. So that's why you see high in so many of these columns, and the quant stands out as the outlier. Okay, so let me, that's almost right at 9, so let me stop sharing, see if there's any questions, and Okay, so it doesn't look like there's questions. And so yeah, let's wrap up for the evening, and then I'll see you tomorrow for our very final lecture. And also, as a reminder, your assignments are due before class. Okay, thank you. Good night.